Hi, I'm John Geraci, and I'm here with Steve Gallant today from LGA's Tax Department. And we're here to do a postmortem on the Tax Cuts and Jobs Act that affected the 2018 tax year, which was just sort of closed out the filing season at the end of October 2019. And thought we'd spend a little bit of time breaking down the significant elements that affected a lot of individual taxpayers. And I think the starting point for this discussion would be trying to understand what happened with respect to itemized deductions versus standard deductions, because it seems like a lot of our taxpayers who had previously itemized were now taking the standard deduction.
Yeah, I think the biggest single factor there, in addition to the standard deduction being increased to $24,000, was the fact that there's a major limitation on the state and local tax deduction. People with large real estate tax bills and their income tax paid to the states is capped at $10,000. Therefore, if you don't have a lot of mortgage interest and your investment fees are not deductible anymore and several other miscellaneous itemized deductions are eliminated, you may be well under the $24,000.
So you mentioned mortgage interest, but there was also some changes with respect to the mortgage interest deduction, wasn't there?
Yeah, they put a new cap. The new Tax Act put a cap on the amount of mortgage that interest would be deductible on. So the cap, basically, your highest mortgage could be $750,000 that on property that you purchase post Tax Act, and that includes your principal residence as well as your vacation home.
And the limitation before was $1 million for that amount.
$1.1 million actually, because you could also use your home equity line and be able to spend that $100,000 on anything that you wanted to.
So that would affect some as well. And that would actually affect a lot of taxpayers, obviously, especially that home interest on the home equity line. So
yep.
I guess moving on as we talk about and think about retirement planning and savings, was there any big changes that affected that opportunity?
Not really. There weren't any major changes, but there was an increase in the amount that you're allowed to be able to shelter or contribute to a 401k, an IRA, and you should take a look at that before year end to make sure that you've maxed out if you can.
Okay, makes sense. And as we think about sort of some of the other big changes, one thing that comes to mind is the significant increase in the estate tax deduction. And I know there's been a lot of recent press about that. What changed with respect to that, and what's this recent discussion that's been going on?
Well, part of the Tax Act in the reform, they basically for 2019, your lifetime exclusion, it was $11,400,000, and that's for both husband and wife. And what happened was the concern with a lot of our clients as well is that what if I give away the $11,400,000, and what happens at the end of this sunset period, and starting after 2025, the lifetime exclusion goes back down to $5 million. And the IRS recently came out and said that they would not try to claw back that amount, so that you're safe. If you give away $11,400,000, it's going to stay out of your state.
Wow! So it went from $5 million to $11.4 million, and times two, that's almost $23 million versus $10 million. So that's a pretty significant change, and that's great that they sort of put people's mind at ease with respect to that clawback concept. So
yep.
I guess the last thing that I know affected a significant number of taxpayers, and it was something that was sort of done in response to the favorable changes that affected C Corps, was this 199A deduction, as it's called, a qualified business deduction. Can you talk a little bit about that and how that ended up playing out for a lot of taxpayers?
Sure. It impacted probably the majority of our clients in some way or another. Of course, you get, if you're a trade or business and you file a Schedule C, in other words, you report it on your individual income tax return, you get that 20% deduction. If you have a business through an S Corp or a partnership, same deal, pass through. There are a lot of complicated rules relative to the type of business you're in and limitations there. And then the other thing that was brought to our attention and get clarified in January of 2019, just before the filing season, was the fact that certain rental income would be eligible for the qualified business income and the 20% deduction.
Oh, so that must have affected a significant amount of taxpayers who are invested in real estate.
It certainly did.
So now all these provisions are essentially set to sunset at the end of 2025. So barring some change in leadership, we're expecting these to sort of remain in effect, but obviously that can change.
Absolutely, and we're constantly looking at regulations now that are being finalized with regard to all these Tax Reform Act changes, and every day there seems to be something coming out without even talking about the states either adopting the new law or doing something different from the new law.
Well, I'm sure there's a lot of relief. We have this first year sort of behind us, and we'll be moving on to the 2020 filing season, hopefully with a little more knowns up front. So if you have any questions about how the TCJA affected you or impacted you or opportunities that exist within it, obviously at any time, please feel free to reach out to Steve Gallant or anyone on LGA's tax team.
We'd be happy to help.